Right now, somewhere in your banking app, there is a number quietly insulting you. If you bank with one of the three biggest banks in America, that number is likely 1/100th of 1%. Meanwhile, a few taps away on that same phone, competitive accounts are paying up to 4.5%. This gap creates a massive difference in real dollars. If you park $30,000 at a standard big bank for a year, you earn about $3. Put that exact same money in a competitive account with identical federal insurance, and you earn over $1,300. Inflation ensures that idle cash loses purchasing power every day it sits still. With core inflation recently running at 2.6%, your money buys you less every year you leave it in a traditional account. A big bank paying 1 penny per $100 per year is handing you a yield so small, a vintage gumball machine would reject it. By contrast, a yield of 4.5% beats inflation by about a point. You maintain your wealth using the same country, the same week, and the same risk profile as the person earning next to nothing. Leaving your cash in a low-yield account is an active decision to let your wealth shrink while the bank profits. Today's 4.5% interest rates are the tail end of a long, quiet decline, even as headlines describe a savings comeback. In 2023, top accounts paid over 5%. Then the Fed dropped the target rate to 3.5% by 2025. Banks passed those cuts along immediately. This deposit beta is asymmetric. Banks instantly pass on cuts, but hikes rarely reach you. Banks capture the difference by lending your cash out at much higher percentages for mortgages, while paying you almost nothing. Between 2022 and 2023, the Fed ran its fastest hiking cycle in 40 years. During that entire stretch, traditional savings rates stayed at zero. The banks declined to pass the gains along, and it worked because almost nobody left. The average American has banked with the same institution for 17 years. Because your direct deposit and auto pays are already linked, the friction of switching makes moving your money feel like a day of paperwork. The modern banking system is optimized to profit from this apathy. The entire relationship is designed around the assumption that you will never check your rate. Simply searching for the highest number is a mistake. Many top-tier rates are temporary promotional gimmicks or only apply to the first few $100s of your balance. There is also a major difference between actual chartered banks and fintech middleware apps. These apps offer clean interfaces, but partner with banks to hold your money in shared accounts. These apps rely on pass-through FDIC insurance, which only works if the tech company maintains an accurate record of your portion. In 2024, a middleware company called Synapse went bankrupt, and the system collapsed. The ledgers hadn't been reconciled, and the digital records fractured. Over 100,000 people were locked out of their funds. Even though the money sat in insured banks, those banks no longer knew which dollars belonged to which customers. Chasing an extra 15 basis points on a third-party app risks your entire principal for an extra $45 a year. Financial safety requires confirming exactly whose name is on the bank charter. Structural security is more important than a friendly app interface. There is a hidden variable in your interest rate, state and local taxes. Savings interest is taxed as ordinary income, which can eat a significant portion of your return. This is why U.S. Treasury bills are often superior for high earners. While they are taxed federally, they are exempt from state and local income tax. In a high-tax state like California, a Treasury bill can net nearly 30% more after-tax income than a savings account with a similar rate. In states with no income tax, that advantage disappears. In those cases, the high-yield savings account wins on pure convenience. Ultimately, cash serves as a defensive emergency fund to prevent debt, rather than a long-term engine for wealth. Stocks are for building a fortune. Cash is for ensuring one bad week doesn't become a credit card balance you carry for years. To optimize your cash, follow this checklist. Verify the rate is permanent. Ensure it applies to your entire balance. Confirm you are using a real chartered bank, and stay under the $250,000 insurance limit. Taking 15 minutes to properly position your cash is the highest-paying, lowest-risk financial action you can take to protect your economic foundation this year.